Hi guys, welcome back to another video. Today we're going to be talking about everything you need to know about trading full-time for a living. So I haven't been doing content for a while, but I've still been trading and I've still been, working on myself. So this video is going to be a video on how you need to get started on trading this year or investing in the markets, and I'll go about how it is, the ups and downs of really doing this full-time. So off the cuff, this whole video will just be me talking pretty impromptu, so pardon me if I say anything stupid or just please be kind. Yeah, so first things first, I got some questions asking like what happened to me, why did I stop doing social media? Basically, I took a break for my mental health. I'm not going to go too deep into it, but I think I'm just trying to work on myself more. Not so specific in terms of the financial part. I did lose, but overall I've been still profitable. I still am, which is why I'm doing this. But yeah, so right now I'm trying to focus more on creating some content back, but I'm pivoting towards doing more finance content instead of fitness, which I was previously known for, but I didn't really like it. And as I grow older, I think priorities change. There's a limit of diminishing returns if I put it in an economic standpoint of how much stronger and fitter I can get. But I feel more passionate about growing businesses and finances, so I'm probably just going to head into that direction. Okay, so how do I trade for a living? So basically, for the past 6 or 7 odd years, I've already been in the market and invested in the market, but I've been doing it quite silently. So most of my social media has always just been about random shit and me growing up and being immature, which some things I regret, but I guess that's part and parcel of growing up. I'll share about that later. Why do I do social media? I have no idea. I mean, I've already had so much sunk cost into it. I guess that's a fallacy, but more so just to document the journey. So hopefully it leads to something else. But one thing I learned from social media is that it helped me open doors to a lot of networks. I guess I met some interesting people through it, and I also met like my mentors and friends through there. So I don't really particularly regret it, but I guess I was immature and stupid in my earlier years. Oh shit. Okay, let's see if this. So the first thing you gotta ask yourself is, are you gonna be an investor or a trader? And when you look into these things, it really depends on your style. If you are having a full-time job, it might be more difficult for you to commit time into day trading speculatively. So preferably you might do something like taking more long-term approach to the market, right? Instead of a short-term strategy. So if you're doing something like a position trader, you actually do larger swings, and further down that line, you're becoming a swing trader, becoming a day trader where you're much more speculative. And at the extreme end of it, you're a scalper where you're doing 1 to 5 minutes time frames on a very high volatility market. Obviously, the more speculative you are, the more experienced you should be. So personally for me, to manage my own risk appetite and tolerance, which I mentioned just now, for my core portfolio, I do a more passive investment strategy these days, where I'm aiming for about 1 to 2%. I do an option strategy on that. I'll share more on that later. And on my more speculative end, I do stuff like futures, crypto futures, and I do CFD. So that's obviously a smaller account, but it's still significant to me, where it's about maybe 2% to 5% of my net worth, depending on how aggressive I want to be and my flexibility arrangement during that period. Because right now I'm really doing this full time, so when I'm more free, I generally can take more tolerance because I'm paying more attention to the market. I'm literally staring at the charts every single day, every single second. So when people glamorize it, where they say that you can like live a full fun life, yeah, you can do that. But when the market is volatile and you need to sit down and put the pedal to the metal, you should do it, right? So another question I'll have is, how do you approach your long-term strategy and how do I approach my short-term strategy? For my long-term strategy, I like to do options, right? So stuff like your wheel strategy or your covered calls, where if you're holding a lot of holdings in a stock, you're able to sell calls on them and to lower your cost average down. Like I said, if all these terms are unfamiliar with you, you should read more about it, but I'll probably do some videos on that as well and conducting some workshops or classes eventually in the future, but not my priority right now. And for me, another thing that I like to do is credit spreads. So why do I do credit spreads? Specifically, I think that it's very good in this market because right now we're in a sort of kangaroo market. If you look at both S&P indices and maybe some certain stocks as well as Bitcoin, probably we are in a range right now, right? So why are we in a range? Because the market has a lot of indecision. We are still not sure what the Fed is going to do in terms of interest rate hikes, or we're going to ease. Generally, I think we're in a prolonged recession. We're just going to be in a choppy kangaroo market for a much longer period of time. And I'll give you my thesis on that later on. But why do I like to employ credit spreads? Basically, one thing I notice about the markets is that generally when they introduce new derivatives, it's a sign of a reversal. So what do I mean by new derivatives? Um, Back in October 2017, they introduced Bitcoin futures, right? So let me see where's that. Yeah, the CME group introduced Bitcoin futures, and that's also when the market from 20k turned to 3k. So that shows that there was like extreme greed in the market. Likewise, when there's extreme fear, it reverses. Right now, in the last year, there was a lot of new money in the system where during COVID, uh, there was a lot of people trying to speculate into the market, and that's when they introduced zero dated options. So there's a lot of assets and fake volume in the market where people are speculating on a short-term basis. They're saying, oh, we're going to run up in the next few days, so we'll buy a weekly call or a daily zero DTE call option. Basically, since the market has such a high number of people doing short-term options, the best way to kill everybody, which is what the market makers want to do, would be to let it chop. Because if you chop, all the premiums will go to people who are doing credit spreads. And where am I making all this money is where people are speculating and they are losing their premiums, and then you can collect the credits from that. So when I talk about credit spreads, it's a much more chill way of like speculating in the market where you just predict that it doesn't go to a certain area. So if you're going to look at my Telegram channel, the last month I did a gold bear put spread as well as indices bear call spread. So the difference between call spreads and put spreads, okay, like I said, you should read up more about this, but a put spread is just generally more aggressive. It can be a bearish put spread or it can be a bullish put spread. And obviously bullish, you're looking at upside, bearish, you're looking at downside. A call spread is generally more conservative, so you're looking at more limited increase or limited decrease in it. So generally, I was looking at major increase in gold because I still think we're in an inflationary environment. No matter what the data says, I still think that inflation is very sticky. And right now that okay, in a couple of days ago, I think yesterday, we had PPI data and CPI data come out. We said that it's lower than forecast by 0.1%. Does that really matter? In the grand scheme of things, yes, inflation is slowing down. Interest rate hikes are working. However, the real value of inflation, if you can look at your day-to-day, the meals that you're buying and everything is still expensive and it will continue being expensive. So inflation is not going anywhere. And I think that one safe bet, if you're going to do a spread, would be gold. Because I still don't think gold breaks 1800 or even this area. So all I'm doing is buying bull put spreads, right? So bull put spreads saying that it doesn't go to this area in the next couple of months, and I think it will just continue staying there. I'm not worried about day-to-day market volatility because I'm still collecting the premiums on that. However, I will have to remind you that this is not going to be a large RI. It's just probably going to be 1-2%. And on my more speculative account, I have been doubling and tripling and being very aggressive with my crypto futures. I am also going to be doing a copy trading function on this, so you can copy me if you want, but at your own risk. I'm also sharing some of my directional trades on this. The last couple of weeks, I have made a sizable amount on that. You can just check on your Telegram, but obviously this is my much more speculative account. I'm using about 20 to 30 times leverage, risking about 5%, and I'm really trading on very aggressive strategy there, so at your own risk, right? So continuing on, how do I trade on the short-term strategy? After we talk about a long-term strategy, we talk about our spreads, our wheel strategy, our covered calls. Do I personally hold a lot of long-term holdings? Yeah, not really right now, because I still don't think that I would rather put my money to better use by trading it and employing it for all of my different option strategies rather than buy a lump sum amount right now when I don't think we're going to get a very bullish market next year. Bear in mind that we are still in a tightening environment. Even though we are slowing down the tightening or we might be pausing it, I still think the market has no room to run up because there's no QE. As long as Powell is still in charge, I read the news quite often. Yesterday, they said that the Americans are losing their confidence in him and is at an all-time low. But I'm sure what Yellen and the rest of the Fed people want to do is to go back to QE. Everybody wants to go back to QE where we just print money again and they can help their bank friends that way. But as long as the status quo stays, you might think interest rate is high, but it can go a lot higher still. Obviously, I don't think that we should do that because we don't want to cause a hard landing and a severe recession. But in the past, when you look at what Paul Volcker did, interest rates can go way beyond 10%. It can even go 17, 18, 19% possibly. So where we are at now in the idea of the Fed funds rate being at about 5% is not, say, exactly super high. And the bond market is pricing that in already. So in general, I think that I'm not saying that we'll go there, but there's still a long way to go before we actually finish fighting this inflation, right? So I'll share more about that later. But on terms of my short-term strategy, sorry for jumping around a lot, just doing this off the cuff. I generally like my FA to tie in, and the narrative of the FA have to confluence with my TA. So obviously on my TA indicators, I use stuff like stochastics, RSIs, and Elliott wave sometimes. And on a very, very short time frame, I use volume weighted average price, so VWAP. Those are the strategies I use, right? But it also has to confluence with the FA. So in general, what I posted a couple of days ago on the Telegram channel was basically, I think that a lot of the market news are useless, right? So basically, when they said that inflation went down, I think that the market will fade it because all this news, right, comes out before the market opens, the US market opens, and now that when daylight savings is an hour earlier, so it's about 8:30, right? 8, right? Then basically, since the news came out an hour before the market opened, it ran out on pre-market, but when people and retails jumped in on it saying, "Oh, inflation is down, equity should go up, SPY should go up," they bait the retail in, and after that dump. So generally, you need to have some kind of experience in the market to trade short-term strategies. Still holding on to my trades. Right now, I'm on a Bitcoin short from 28, 29K. I'm still holding it down. The average price has dropped because I've closed and opened it again on a shorter term basis, but I'm trading according to my AUM, which is the assets under management on this account. So if you guys don't know, I'm currently trading on 2bit, which is a cryptocurrency exchange. That's where I'm more speculative on. I've put about 1,000 USDT exactly, actually, 3 days ago, and right now it's moving towards 4,000. So essentially quadrupling the amount. But obviously, this is only possible because I'm a lot more speculative in nature, and crypto moves very fast and it's volatile. So right now, there's this copy trading function where you can copy other traders. Not particularly saying me, but there's other traders that you can copy. And you also get a deposit bonus of 2%. And you get rewards up to 600 USDT. So doubling your profits. If you trade a certain amount of volume, you get double the profits. Yeah, so if you want to go sign up for that, link is in the bio below. And yeah, let's get on to the rest of the video. So in terms of my holdings right now, everybody knows which sector is going to perform in the future. AI, right? It's quite brain dead that AI is the one to go. That's why NVIDIA is running up so much. Based on that, you still have to balance your portfolio out using stuff like your Sharpe ratio, and you have to sector base, right? Depends what you're more heavily invested into it. I always said that I like Lockheed Martin because I think that no matter what the US does, no matter if we lose, it loses reserve currency status. And by the way, all that fear about the reserve currency status losing to the BRICS, I think is overstated because to actually topple a reserve currency would take decades, right? So we're not going to lose it immediately, but if you go and look at the USD DXY chart, it's on a clear downtrend. We are definitely losing it's definitely losing value. Okay. So if you want to go and look into your own portfolio management, you gotta look in stuff like your Pharma French model, your valuations, your EBIT and everything else, right? Your price to earnings ratio, your price to sales ratio. You balance out your portfolio, and basically you should always have some in some certain sectors. In general, in a recessionary environment, you should be looking into more defensive stocks, of course, and sometimes you have to look into more commodities as well, because I still think that in an inflationary environment, inflation before recession, or inflationary environment, commodities will still perform. So that's why I still like gold. I still think inflation is here to stay, and that's a chunk of my portfolio as well. Okay, so I'm gonna go into some historical, boring stuff. So we're gonna talk about the gold standard and why I like gold. Okay, basically, if y'all don't know the history of gold, I think in they bought it for $20 an ounce. When was that? Yeah, in 1920s, right? They basically said, "Hey, we're gonna move to the gold standard," and they just bought it at $20 an ounce. They're going back and forth with this. So after that, they had a Nixon shock where they took away the gold standard and then they allowed them to print money, and that was when we had our economic boom. If you look at the history of civilization, we had industrialization, then we had recession, then we had taking off the gold standard, and then we back to QE, back to QT, back to QE, back to QT. This also comes into play about certain generations being more lucky than others. I'm not making excuses for myself, but in general, right, if you read this book called Outliers by Malcolm Gladwell or Creature on Jekyll Island, it goes very in depth about the history of money. That's why we have certain generations succeeding so much, and there's generational wealth. You look at Vanderbilt or Rothschild, they amassed it over those industrialization age, and when they were able to take advantage of a QE system. I'm not saying you can't make money right now, but you just have to be a lot smarter, and you got to be realistic yourself that there is less opportunity. So I was looking at this chart about fertility rate and boomers and generational cycles and their power. So obviously baby boomers and Gen X, I would say they're the most lucky, right? And generally in a recessionary environment, everyone knows that it's hard to get jobs, our income is dropping, and we are also having a lower fertility rate, so that sucks, right? But this quote I always stand by, I love this quote: hard times create strong men, and strong men create good times, and good times create weak men, and weak men create hard times. Basically, we're just going through the general ebbs and flows of the market cycle. But one thing I like to read about the fertility rate is that a very good example of this would be Japan, right? So if you look at the history of Japan, there was this time where they did negative interest rates, where they were actually paying you to borrow money at negative 0.01 for a very, very short period of time, but it was negative, right? What this means is that there was so much spare cash around that they were giving out, and people were buying houses and whatnot, and then they had so much abundance during this period. And look at it right now. To put it very plainly, Japan is a society of weeaboos and everyone knows it's a declining population. And aside from that, a lot of them, guys, they don't even want to have partners anymore. They're just going online to, for lack of better words, OnlyFans or porn sites, which is why they have the biggest porn industry. And I'm not saying that's what's going to happen in the rest of the world, but because they also have their own, a bit more traditional and conservative closeted style of living, which is also, and they also had a high savings rate, which was why the QE didn't work. But I don't go into all that with you. I'm just saying that generally it's got what happened during after QE. There's QT, and then we have low fertility rates in recession, and generally that's government has to do something about it basically. But I think in a more long-term time frame, Singapore is smart in that sense that even though housing is expensive, we have good policies, and we still look very long-term, broader into the future, where I think that we have a good chunk of reserves that if we want to stimulate fertility, or we could just bring in more foreigners. I'm not sure how that works out. I'm not a politician, but I'm basically a trader. So yeah. What am I saying right now? I don't know what I'm saying. Oh yeah, if you want to know how to manage all these different economic situations, a very good book is this book called Trainwreck 6 Scenarios. So it shows the different scenarios, whether we're in a Goldilocks scenario, if I can remember correctly, whether we're in a recession environment, what to do, whether we should buy bonds, whether we should buy gold, whether we should buy commodities, or whether we should buy equities. In our generation, I think it's not the right time to buy equities, because if you look at what Japan did, not saying we're exactly the same. US and Japan is not exactly the same, because US is a much more liberal country by nature. But if you look at the history of that, it's not the right time, because Japan actually, the Nikkei dropped for 30 years before it finally recovered. And till this day, there is still an excess of, if you want to invest in real estate, there's still an excess of real estate there. But why I wouldn't buy a real estate property in Japan is because, I read the news that people can buy abandoned Japanese houses for $30,000 or something like that. But they're not earthquake proof. If we look at a day ago, I think 11 May, there was a 5 point something magnitude earthquake there. And all these abandoned houses are not earthquake proof. So if you're looking into investing in real estate, I still think Hong Kong and Singapore, okay, Hong Kong is a bit overstretched already, but Singapore always will have a place in real estate investing because we are just land scarce. It's like a unfortunate scenario, right, where we're just land scarce. If you look into other developing countries like Malaysia, it's hard to say because there's corruption there, the politics is a bit messed up, and they have so much land. There's not much demand there. So investing in real estate in Malaysia might not be the smartest thing, but maybe in other countries like Thailand or Vietnam, if you have connections, because it's extremely easy to get scammed there. And the one thing you do is just not get scammed, right? So I'm going to close off with my thoughts on Bitcoin and gold. I still don't see Bitcoin as a safe haven asset as much as people like to say it is the new reserve currency, or the BRICS, the Brazil, Russia, India, China is going to take over the US currency. It's going to take a long, long time before they take over the US as that as a position. And to me, Bitcoin is still too volatile, too speculative. Doesn't mean I don't invest in it, because I'm not saying buy Bitcoin, but basically when you look at, there's a stat that says that less than 1 million addresses have one singular Bitcoin. And if there's 21 million in circulation, then probably 3 to 4 million is lost. There's only 70 million out there, right? If everybody buys a little bit, the potential is there for it to fly. Look at its market cap. It's still so far below gold. So having some is not wrong for a Gen Z or millennial our age. Okay, I'm not saying you're my age. I don't know how old you are. But basically, having some is not a bad idea. Just that you shouldn't have such a large amount. For me, it's just whatever you can tolerate a drawdown for. You hold for the long term. And obviously, when you're talking about these 1 million addresses, some of these are hot wallets. They are exchange wallets. So like Binance or FTX or the exchange I'm using, 2bit, they all have their own hot wallet, right? Where they hold the reserves of everybody who invests their fiat currency inside there. The danger of that is what happened with FTX, where they can become insolvent. They might use it for... You never know where the money goes. When you put money into an NFT, they have their floor price and everything, but you don't really know where the actual money goes, right? So it's obviously still good to hold a cold wallet, but I would still trade with a hot wallet, which is what I'm doing right now, right? But once you... I think you should still hold some in a cold wallet in case one day it does take... It's like a just in case thing, a FOMO thing, but buying a few thousand is not, say, the worst thing in the world. Okay, so that's my take on Bitcoin. It's not, say, it's gonna take over the world, but yeah. When you look at gold, the reason I still like gold is because when you look at the historical value of gold in the past, gold has been between 1 to 2K for the last 20 years. You look at Peter Schiff, he keeps talking about gold, right? In a recession and in inflation, I still think gold has the technical momentum to go to a 2.6, 2.7 quite easily. And I know that it's not a huge ROI, but if you can get 30% on your asset, it's pretty decent. So gold is still a decent amount of my portfolio, and if I'm still a little bit more conservative on that, I approach it with a bull put spread or a bull call spread if you're even more conservative. Okay, so that's my take on the markets in general right now. If you want to support me, do sign up with the referral links below to 2bit and I think XM right now. But I'm trading crypto futures in 2bit, which means that I'll be doing a copy trading function. You can copy me or you can just buy your own crypto there. I'm not really going to advocate anything. But yeah, do like, share, and subscribe. And yeah, see you guys next time. Bye. That was a very long video.